Hello, my name is Sarah Keys and I'm a volunteer with the CPA Canada Financial Literacy Program. Today we're going to spend about an hour or so going through financial ratios and why they matter to your business. This session is designed to be interactive, so please speak up if you have questions or concerns, you need clarification. Just raise your hand at any point as we go through the material. I'll also leave some time for questions at the end, so if you want to wait until that point, there'll also be a Q&A opportunity. A copy of the slides will be available after the presentation, so you can take them home with you. You're going to want to outline some of the logistics of the room. Let people know where the bathrooms are, if there's a scheduled break or not, so that people can feel comfortable to move around and know whether or not they have the ability to leave the room or stay right in the room. Okay, so some of the common questions that owners ask are outlined on this slide. So, how profitable is my business? How do my profits compare to the industry? What are the trends in my profits over time? How quickly are we growing? Can we pay the bills? Can we pay the bank? And am I getting a return on my investment? So these questions are critical to the owner of any business, and we should always be evaluating as we move through time. So, what are financial ratios? Financial ratios are tools that can be used to systematically analyze and examine financial statements. Note the emphasis on the word systematically. So what does it mean, the term ratio? So a ratio is just simply a tool to compare one number to another. They're really better sources of comparison than just eyeballing the numbers, because it allows you to have this systematic, unbiased comparison. So the financial ratios that we'll discuss during this session will allow you to evaluate profitability, analyze trends, measure growth, evaluate borrowing capacity, and measure your bill paying ability. So you can think of ratios like the gauges on the dashboard of your car. They tell you what's going on in the business. And so when you think about your car dashboard, you've probably got a battery gauge, a gas gauge, and a temperature gauge. So if any of these items go out of the safe zone, so your gas gauge goes down to 0 or your temperature gauge goes into the red zone, the car just isn't going to work. So simply put, these ratios are actually like a dashboard for your business. If any of them go out of these proper zones, and we'll give you some indications of what those proper zones are as we go through this presentation, this will give you an indication there might be a problem with your business. And this is something you might want to investigate further before it becomes a real problem for you. Each of the profitability ratios that we're going to go through, I'll provide examples from a sample business. So it's really important to understand and measure the profitability of your business. And the profitability ratios we're going to discuss will allow you to measure both profitability and returns. So there are 5 key profitability ratios that we'll be discussing today. Margins that measure the profit from sales, from the operation of the business, and the overall profitability of the business. We'll also look at 2 return measures, one on assets and one on the investment in the business, or the owner's equity. So here we have an example of a profit and loss statement, and what I'll do here is go through the 3 margins that we're going to calculate. So the gross margin is a measure of the percentage profit a business makes on sales. The formula for the gross margin is gross profit, which can be found on the profit and loss statement, as exampled here, divided by revenue, and that can also be found on the profit and loss statement. So in our example here, we see revenue of $50,000, cost of goods sold of $18,000, and gross profit of $32,000. So if you divide $32,000 gross profit by $50,000 revenue, we see that the gross margin is 64%. So what does that mean? This means that our sample business is earning 64 cents on each dollar sale on average. Now we move on to the operating margin. So the operating margin is another measure of profitability after the operating expenses have been included. So the formula for the operating margin is similar to the formula for the gross margin, except the numerator is now operating profit, which is divided by revenue. So in our example, we have an operating profit of $9,167, which was taken from the profit and loss statement. That's divided by the revenue of $50,000 and yields an operating margin of 18%. So in this case, this means our sample business has an operating profit of 18 cents on each dollar of sales on average. Lastly, we'll take a look at the net margin. And the net margin is a measure of profitability of the overall business after all expenses, interest payments, and taxes have been paid. It's also referred to as the bottom line profit. So in our sample business here, we've got a net profit of $5,471 divided by the revenue of $50,000, which gives you a net margin of 11%. So the bottom line is that our sample business makes a profit of 11 cents on each dollar of sales on average. Gross margins, operating margins, and net margins will vary based on the type of business that you're running. So consumer-centric businesses typically have higher margins than operational-centric businesses. You may want to adjust the example that you give when you're emphasizing this last point of the difference between consumer-centric and operational-centric businesses so that individuals in the class can actually understand what this means. This is somewhat of an abstract concept, so you may want to give an example of a service business which has a higher margin due to lower fixed costs, and a manufacturing company which will typically have lower margins. In order to calculate the other two profitability ratios, which are focused on returns, we now need to take a look at the balance sheet. So here you'll be able to see the assets and the owner's equity information on the balance sheet. So I just want to highlight for you the total assets are $100,000 from the balance sheet, and we'll be using this in the examples on the following slides. And the total owner's equity on the balance sheet is $40,000. Later in the presentation, we'll be covering liquidity ratios, so I do want to highlight the current asset value here and the current liability value, and we'll touch on these later. So at this point, we're going to take a look at the two return ratios for profitability. So now I'd like you to take out your handout on examining profitability, and individually I'd like you to find the following 4 line items: total assets, total owner's equity, current assets, and current liabilities. You may want to circulate around the room to ask people if they have any questions or if they're having any concerns with finding any of these items. In individual exercises, this is new information to people, so you want to make sure they feel as comfortable as possible, but also are engaged in the discussion and following the example. So now we'll actually put into practice the calculation of return on assets. So return on assets measures how effectively the assets are being used by the business. So the formula for return on assets is net profit divided by total assets. So the net profit came from the profit and loss statement, and the total assets came from the balance sheet. So that's why we had to go through that exercise. In our example, the business had a net profit of $5,471, which we divide by the total assets of $100,000. So we find a return on assets of 5.47%. You could take that number now and compare it to the returns for alternative uses of those assets to determine if you're using them as effectively as possible. For this slide, calculating return on assets, and the next slide, calculating return on equity, ensure you tie these examples in to the treasure hunt activity. This way, participants will continue to be engaged and understand how they might be able to do this practically on their own after the course. So, return on equity, our last profitability ratio, is a measure of the return that the owner of the business is receiving from his or her investment. This is a key measure, and it's often used to compare the results of this investment to alternative investment opportunities. So the formula for the return on equity is the net profit, which came from the profit and loss statement, divided by the total equity, which is found on the balance sheet. This ties into our treasure hunt activity. In our example, we divide the $5,471 net profit by the $40,000 of owner's equity, which we found on the balance sheet. The return on equity in our example is 13.68%. So you might take this number and compare this to the return of alternative uses of your money, such as other business investment opportunities and the return from bank accounts and other personal investment opportunities. So ratios allow the comparison of a business to the industry benchmarks as well as to competitors. So these ratios are very helpful in us to benchmark and understand how are we performing relative to our industry. So while it's not always possible to find this data for privately held companies, there's often industry trade association data available for a lot of specific industries. So an owner can compare their profitability ratios that we've just calculated to trade association data specific to your industry. And this will be key if you don't have an opportunity to see the information from your competitors because they're privately held. Alternatively, you may be able to go online and calculate the profitability ratios of public companies in your industry, and this will provide a comparison so you can benchmark how you're doing relative to your competitors. So some of the key data sources for doing the comparability of profitability ratios are trade association databases, university databases, government census, and Commerce Department databases. You may want to customize this based on the audience. So if you have an audience that's in a specific sector or industry, you may want to actually give examples of some of the databases that you would pull from. This would be helpful for individuals to actually take this away and make it a practical outcome of the session. Liquidity ratios are absolutely important because businesses fail when they can't pay their bills. So liquidity ratios are the measure of a business's ability to pay its upcoming bills. So there's two key liquidity ratios, the current ratio and the quick ratio, and we'll cover these in detail with some examples on the following slides. When a banker or an investor is evaluating a company, they're almost always going to look at these liquidity ratios because they're such an important measure of financial health. The current ratio measures a business's ability to pay its bills over the next year. So it compares the dollar amount of the current assets to the dollar amount of the current liabilities. Recall that the definition for current assets includes cash, accounts receivable, and inventory. Recall that the definition of current liabilities typically includes accounts payable, loan principal repayments that are coming up due in the next year, and other payments that need to be made in the next year, for example, interest on a loan. In our example, we take the balance sheet from XYZ Corp. And we see that the current assets are $60,000 and the current liabilities $35,000. So when we divide the current assets of $60,000 by the current liabilities of $35,000, we see that the resulting ratio is 1.7. So what does that mean? The current ratio allows us to understand whether a company can pay its upcoming bills. So the current ratio of 1 or more indicates that the company can pay its upcoming bills. Many lenders, though, will be looking for ratios greater than 1.5. You may want to explain why bankers and lenders would choose to go with 1.5 or higher rather than 1. And that's simply because if they're going to be issuing new debt, they're going to want to make sure that they can also be repaid on their loan repayments and their interest. So this will then shift the ratio of assets to liabilities for calculating the current ratio. So typically they want to give themselves some of that buffer room. The second liquidity ratio we'll be looking at today is the quick ratio. So the calculation of the current ratio assumed that inventory was a current asset that could be converted to cash within the next year. The other current assets, such as cash and accounts receivable, are typically pretty liquid. They can be quickly converted into cash. However, inventory has to be sold to be converted into cash. So the quick ratio provides that comparison of assets that are already in cash or can be quickly converted into cash, such as accounts receivable and cash, but not inventory. And then we compare this to the bills due in the next year. Emphasize that the denominator in this equation has not changed. There is no difference between the current liability value used in the current ratio to the quick ratio. The only change here is the removal of inventory from the numerator. The formula for the quick ratio is current assets less inventory divided by current liabilities. So in our example, the company has current assets of $40,000 after you've removed inventory and current liabilities of $35,000. So the quick ratio is 1.1. A healthy business has to have a quick ratio of at least 1, and it indicates that they can pay all of their upcoming bills with cash or items that can be readily converted into cash. So if there's anything below a 1.0 for a quick ratio, it's indicating to a banker or an investor that the business might have some difficulty in paying its upcoming bills in the next year. Before presenting the leverage slide, ask your audience if they have any questions. This is a lot of information for individuals to take in, especially when it's a new topic area, and leverage can be a little bit more of a complex set of ratios. So before you jump into the leverage ratios, take a moment and ask your audience if anyone has any questions or concerns with the material presented. So, understanding leverage. So when a banker evaluates the ability of a business to make its loan payments, they're going to rely on an analysis of leverage ratios. Now, leverage ratios measure the overall debt level in the business to their ability to repay existing and new loans. The key leverage ratios that we're going to cover are the debt to equity ratio, the interest coverage ratio, and the fixed payment coverage ratio. And I'll go through examples of these on the next slides. So businesses have two primary sources of funds: debt and owner's investment, also called owner's equity. Most businesses will use a mix of both debt and equity. Now, while some businesses don't have any debt and they're 100% equity, it's very uncommon for the opposite to be true. A business funded entirely by debt is not very common. So banks generally don't want to be the only investors in a business. They'd like to know that you too are invested in your business. So now we'll take a look at the debt to equity ratio, and that measures the amount of debt and other liabilities in relation to the equity. And banks are always looking for low debt to equity ratios. So the formula for the debt to equity ratio is total liabilities divided by owner's equity. In our example, total liabilities are $60,000 and owner's equity is $100,000. So the debt to equity ratio is 0.6. 0.6 means that 60% of the business is funded by debt. This is another way to interpret the debt to equity ratio. Many industries will have specific thresholds for which bankers will be looking. You may wish to customize this presentation based on your audience and give an example or two of different debt to equity ratios that are commonly accepted in different industries. The next ratio we'll be looking at to understand leverage is the interest coverage ratio. So a banker will also look at the business's ability to make its interest payments from the profits of operating the business. The interest coverage ratio measures the ability of the business to make its interest payments from its operating profits. So the formula for the interest coverage ratio is the operating profit, which we found from the profit and loss statement, divided by the interest payments, also from the profit and loss statement. When a banker underwrites a loan request, they'll typically look at the interest coverage ratio with the existing debt, but they'll also take a look at the interest coverage ratio that would be projected if they were to give you the loan that you're requesting. So typically bankers are looking for interest coverage ratios of at least 2. And in our example, the operating profit was $9,167, and the interest payments from the profit and loss statement were $750. So our interest coverage ratio for our sample business is 12.2, which a banker would consider very healthy, thinking that they're normally looking for interest coverage ratios of at least 2. The final leverage ratio that we'll be looking at today is the payment coverage ratio. So the interest coverage ratio, which we just covered, assumes that a business uses debt as a source of funds for equipment purchases or other asset purchases. But many businesses, rather than purchasing equipment outright, will actually lease equipment. So this ratio is actually looked at by lenders to evaluate the business's ability to make both its interest payments, but also its asset lease payments. The ratio used to make this comparison is the fixed payment coverage ratio. The numerator of the fixed payment coverage ratio is the operating profit of the business plus the asset lease payments. The reason we add back the asset lease payments in this ratio is because they were actually deducted from the operating profit on the profit and loss statement. The denominator of this ratio is the total fixed payments of the business, and that is interest, principal, and asset lease payments. So in our example, in addition to the $750 of interest payments, which we saw in the profit and loss statement, let's assume our business also had $2,000 worth of lease payments. Adding $2,000 to our $9,167 of operating profit gives us our numerator of $11,167. This is then divided by $2,750, which is the total interest, principal, and asset lease payments. So the interest payments of $750 plus the $2,000 of lease payments. So the fixed payment coverage ratio in this example is 4.1 times. You may want to explain how participants could interpret that ratio. We aren't offering a suggested threshold that bankers or lenders would be looking at, so you may wish to use examples from specific industries or sectors relevant to your audience. So when we're looking at the values of different financial statements from one period to the next, it's often difficult to know how much one number has changed by relative to another. So growth rates, also called percentage change, are a tool that can be used for the systematic analysis of the change in financial statements from one period to the next. So growth rates can be used to identify what's increasing, what's decreasing, and what's staying the same. They can also be used to spot positive or negative trends affecting the operation of your business and analyze product or strategy changes that you might be considering. So the formula for a growth rate is the ending value minus the beginning value divided by the beginning value, and we'll walk through a few examples. So now we'll give you a chance to examine growth rates. Please take out your Examining Growth Rates handout and find a partner. And what we're asking you to do is calculate the growth rates of the line items included on this handout: revenue, cost of goods sold, gross profit, operating expenses, and operating profit. So which increases more, expenses or revenues? Is the growth positive? And why or why not? These are key decisions you'll need to know when you're evaluating your business. The answers to this activity are presented in the notes to the slides. When you're working through this activity with the participants, show them how these growth rates are calculated for each line item using the information that's provided in the speaker notes. So growth rates provide a tool by which a business can analyze the financial impact of routine changes in activities, and a growth rate indicates which increases more. So consider the example that you went through in the activity. Sales are projected to increase $10,000, and expenses are also expected to increase, and operating profits will change. So the key questions a manager should be asking are the expenses increasing more or less than the increase in sales? And with that growth, will the business be more profitable? So without the use of a growth rate, or the percentage change, it's impossible to tell at a glance what will happen to the operating profit of the business as a result of this sales increase, and actually evaluate whether the sales increase is a good or a bad idea. Trend analysis is a financial management tool that allows an owner or a manager to systematically compare prior and current period information and identify positive and negative patterns. Trend analysis is an indicator of how the business is doing over time. So presented on this slide are the gross margins, operating margins, and net margins for an example business over a 4-year period. The margins for each period have been compared to the margins for the prior period on this dashboard. Positive changes are indicated in green, such as when the gross margin increases from 55.8% to 56.1% between 2013 and 2014. Indicated in red are the negative changes, such as when the operating margin declines from 12.7% in 2015 to 10.7% in 2016. A dashboard can be a key tool to track favorable or unfavorable trends and key indicators. Color coding can also help to highlight specific favorable or unfavorable trends. You may wish to ask participants how they feel the dashboard is useful in giving a visual example of how trends are changing over time. Typically, people will be more visual than they will in numerical data, so a dashboard can be used for those types of people who receive information more visually and can therefore understand it better. So trends can also be analyzed using data tables and graphs. The data table on the left shows the percent change in sales and operating expenses over a 5-year period. And the chart on the right presents this same information as a line chart. And from the line chart, you can clearly see that operating expenses have been rising faster than revenue during the most recent 3 years. This is an event that might be worthy of additional analysis. That brings us to the end of our presentation of the content of financial ratios. I'd now like to open it up to questions and answers so that individuals can get some clarification on any of the items that we've reviewed today. I know there's been a lot of material covered, so please feel free to ask questions. And remember, there are no dumb questions. In a Q&A session, especially where individuals in the audience are new to the material, it's really important to create a safe environment. Letting participants know that there are no such thing as dumb questions, and creating an environment of openness and accepting helps participants to raise their hand and participate and engage. A reminder that if you have any questions specific to your business and your financial ratios, please contact your financial advisor. They'll be able to give you the best advice specific to your unique needs and situation. This brings us to the close of my presentation and our session today. Thank you so much for your participation, and I hope you found some valuable takeaways that you can apply in your business. Best of luck moving forward, and thank you.